Howdy, everyone. This episode is brought to you by Fireblocks. Love this company. You'll be hearing all about them later from me later in the episode. But now, on with the show. All right, everyone, welcome back to another weekly roundup. First of the new year, I am joined by my intrepid co-host, Mr. Mark Yusko.
I love the adjectives. Intrepid is good, and intrepid makes sense, right? You're sitting there all bundled up like you're in isolation in China where they turn off the heat so there's no air circulating. My guy in Shanghai, he had to go back to the office. They sent him to a hotel 3 weeks in a hat and parka. They bring him food 3 times a day, locked him in the hotel. I mean, the craziness of COVID. All right, so we got to do the sock reveal. And I know you don't like me climbing, but I got to climb. This is important. So you notice red pants have replaced the orange bull market pants. And I got the cold storage Bitcoin. Because look, I thought a lot about the socks this week. And I don't like saying this, and I'm probably going to lose half our listeners because they're going to hate me. We're in crypto winter, and it's going to be here for a while. I don't think it's going to be like a blizzard, horrible, but we're in crypto winter, and kind of been hinting about this since we started in September, but I didn't want to say it because my partners and others were all like, no, it's just moved, right? We're going to have Moon November. No, that didn't happen. Oh, we're going to have a Santa Claus rally. No. Oh, it's going to be March. When you start talking like that, that's when you've lost your objectivity. So,
yeah, I was also in the camp where I thought pretty firmly that the bull market was still in place. I recently, just in the last couple of weeks, I've been like, man, this sentiment reminds me a little bit of back in 2018, 2019. Yeah. I don't have as many years in markets as you do, so it's always great to get your opinions on these sorts of things. But yeah, it doesn't feel, I mean, this isn't where I expected to go, but I guess just to, ponder out loud here. It doesn't feel, though, like the bottom is about to drop out of anything, right? Maybe what this next bear market looks like is just sideways chop, which makes everyone depressed, basically, for the next however long.
Here's the problem. Again, I will let you lead because I'm not supposed to lead, but it's not that the bottom's going to drop out, but it's bear markets are like rubber balls bouncing down a set of stairs. Each bounce is higher. Right? That's the kinetic energy of the rubber ball falling to a lower level. But the end of the trip's a bad place. And I think we've seen it over and over. Remember we talked about this in December, literally the week that the futures ETF was approved. And it was like, yay! And I'm like, no, that's horrible for us. Because now you've created a tool for the big banks who do not want this stuff to drain deposits out of the system to go short. And when you can short a paper asset instead of the physical asset, it creates the ability for suppression. We've talked about this on previous shows, right? What's happening in gold and what JP Morgan does to the price of gold. So, all of it ties back to the Fed handing the ball back to you, which is I know where you want to go. We had an 18-month period where the Fed increased the supply of money 40%. Just mind-numbing. And Bitcoin prices actually rose more than 40%. There was about 100%. And so the fact that we're now coming back toward that 40% level, gold didn't go up 40%. Think about that for a second. Poor Peter Schiff, right? Gold is flat over that period. He's like, no, that's not possible. Gold, which is perfect money, had to go up as the supply of dollars went up, but it didn't because of futures. And so lots of stuff there to unpack later.
Can I my thoughts on this too is I think one of the novel thing that's happened this cycle, right? History never repeats, but it rhymes. Yeah. And I think already right now, like one thing that I was thinking about over the new year was whatever's happening right now, whether we're in a bull or a bear phase or whatever it is, this doesn't look like what's happened in the past already. Right. Because if we're still in a bull market, we're drastically underperforming. If this is a bear, it's weird that it hasn't fallen out faster than this. So I was already kind of thinking, this doesn't remind me of anything that we've been through in the past. I think one of the things that's happened is the whole thing that kicked this whole bull market off was this meme of Fed money printing, right? We're like, there's all this fiscal stimulus, currency is being debased at a record level, people pile into Bitcoin, the liquidity from Bitcoin flows into other alts, et cetera. And I think what needed to happen there was the transition from monetary to fiscal spending, which we like sort of got, right? So there was this record QE forever, super loose, on the monetary side of things for what the Fed was doing, and then Treasury needed to pick up the baton. And they kind of did, right? We got this latest $1.5 trillion infrastructure bill, but it was way less than the market was expecting, the $5 or $6 trillion infrastructure bill. It doesn't look like this is going to be a repeated thing. We have Joe Manchin kind of stepping in and saying, no, thank you. So I think what happened is that the market is just worried about liquidity conditions, and we didn't get the amount of fiscal that we thought we were going to get. That has led to a weaker Bitcoin, weaker gold, and I think you're just seeing the runoff effects of that in crypto.
Yeah, and now, right, you're seeing the impact of deleveraging. And look, this is the antithesis of Ray Dalio's beautiful deleveraging. This is a nasty deleveraging. And I've said this before, and I'll say it again, and I tweeted out, leverage can never make a bad investment good. Never. You buy a shitty house and you lever it up, you're going to lose a lot of money. Right? Now, the problem with leverage is it can, on occasion and often does, make a good investment bad. Like you can have the best house on the best block in the best neighborhood, and if you put too much leverage and you get a quote unquote margin call, now housing is, the margin calls don't really happen as quickly, but you have a big stock account and you're levered. And I mean, imagine owning Peloton, which you thought was a great stock. Right? Great company, great product, great following. That sucker's down 80%. If you had any sort of margin debt on that, you're done. You're out.
Yeah. What's crazy about those pandemic darlings or whatever, Zoom, Peloton, whatever, those things have completely done a round trip. Like go back and look at their price in they've basically gone from May of 2020. They've gone up like 200%. They're all the way back down.
And it's a perfect normal distribution. It's actually, as I tweeted this out this morning, this Twitter friend, he's not a friend. I mean, we never met, but his Twitter friend over in Sweden, Sven, had this great thing about, ARK, ARKK is changing their ticker to Titanic. And I'm like, oh, that's actually pretty good. That's really good. That's very funny. And if you look at Cathie Wood's inflows, they look the same way, right? And people, human beings, do two things really, really well. We buy what we wish we would have bought, and we sell what we're about to need. And it's spectacular. In fact, here's the crazy thing. The ARK Genomics Fund has a negative return. The return, quote unquote, is positive, but the more cash has been lost by people who came into the fund than have gone into the fund. There's a net negative.
How does that work?
Because people buy at the top and they sell at the bottom. So when the big returns on the fund early were earned, it was on very little capital. And ARKK actually is down. It's like I think at the peak, it was a $28 or $29 billion fund, and maybe even bigger than that. And net, it's only got like 40% of people in the fund are positive. 60+% of the people in that fund are underwater. And those people who bought that on leverage, again, if you bought it in a Robinhood account with leverage and you already tried to buy options on it, it works when it works, and then it stops working and it goes really wrong. And that's why I got the red pants on, right? The sea of red, blood in the streets. Now, Lord Rothschild was right. That is the time to buy. But falling knives should fall all the way to the floor. Trying to catch them, you will lose fingers. Let it hit the floor, bounce around a little while, stop moving, then grab it by the handle. So it's too early.
Yeah. So maybe that's a good transition to actually get into some of these charts. Then we can specifically talk, because we're recording this on January the 7th. So we had Fed minutes come out a couple of days ago. So look, it's looking like, to summarize what's going on from the minutes, and I want to get your opinions here, Mark. It looks like the Fed is starting to tighten, right? So now pricing in a probability of 4 separate rate hikes in 2022. Obviously, markets didn't like this at all. If you're watching this via video, you can see we've got the S&P 500 and the Nasdaq up here. The S&P 500 fell almost 2% on the news. The Nasdaq was down over 3% on the news. You anticipated me. So we've got the ARK Innovation ETF, which is down about 7%. Bitcoin down almost 6%. Obviously, Bitcoin, I want to talk a little bit about the internet situation over in Kazakhstan and some of the hash power that went offline. I think that had an impact on pricing. But overall, definitely a very hawkish tilt from the Fed. I think what they want now is for tapering to be, they want to accelerate the pace of tapering. They want that to be done by March when they want to start doing their first rate hike. Mark, what was your takeaway from the Fed minutes and how markets reacted?
It's a giant trial balloon. They know they can't do this, right? They absolutely know they can't do this. But they're trying, right? They're actually trying to do what's right. I mean, short-term rates have equaled the rate of inflation for 140 years up until a few years ago. And then that correlation broke. I mean, it was perfect correlation forever. And that's why the return on cash was always zero. Whatever your cash rate was, that was the inflation rate. And so you had no real return on cash. And then in order to make a real return, you had to take one of four risks. And take credit risk, equity risk, illiquidity risk, or use leverage. And so now we have negative real returns on cash. And that's insane. So we have the loosest monetary policy ever. Like worse than the global financial crisis, worse than the 2014 oil collapse. I mean, it's the loosest ever. Now, that is unsustainable. It's like giving a heroin addict just increasing amounts where eventually there's just not enough that you can inject into someone's veins. And so I really think the Fed is, I used to say Fed in a box, hashtag Fed in a box. And then again, a friend of mine tweeted something out the other day that I thought was great. They said, Fed's really in a pickle. So now I've changed it to Fed in a jar because they're in a jar and they're not getting out. This is the old Prince Albert in a can joke. Hey, Prince Albert can, hey, let him out. So they tried to say they're going to tighten, that they're going to raise rates. Zero chance, right? We already saw Q4 GDP get revised downward. Q1 is going to be ugly. I mean, ugly. Could it be negative? I won't go that far, but it's going to be ugly. Earnings. Earnings. The base effects of 2020 are gone. You got real comps. They're going to be ugly. And you've seen it in these high growth, high valuation companies are just starting to collapse. And, what's really crazy is, here, I'm just anticipating all your great charts. It's the alligator jaws, baby. And, look at the problem with this chart, right? What you're looking at is earnings estimates, and that's rate of change of earnings estimates relative to the price of the S&P, right? Yeah. So the problem is, if you look at the 2000 rollover, earnings collapsed, went negative, and the stock market went down, right? The way it's supposed to. Then the global financial crisis. Now, it was the interesting thing about the global financial crisis. Earnings started to roll over way before the global financial crisis. That was the whole, oh, no, you don't understand. We're the masters of the universe, and we've got all these great products. And then earnings went way negative when they realized, oh, those were all a lie. Those were just fake. So massive. I mean, the biggest negative earnings, and the market went down a lot. And then we started this thing called QE. And we basically have turned the dollar into toilet paper. And the problem with this chart, well, so many charts. One, it's a long-term chart that's not on log scale, which it's chart crime. It's a total chart crime. Right. And you didn't make the chart. And I love Urine. I think he's fantastic. Urine Timmer. I think he's fantastic, but it's still a chart crime. And this is denominated in toilet paper. If you denominated this in gold, it would be a flat line with some wiggles since 1996. And so what you see is the last three times, look at the earnings drop in 2011. I mean, that's a massive earnings drop and the market went straight up. How is that possible? And then you had another earnings drop back with COVID, and the market went down for a couple of days, like it should have. And what again you'll notice is, like in 2006-07, earnings started to go down way before the actual COVID crisis. I mean, companies kind of saw what was happening around the world, and now earnings have started to roll over. Yeah, you had the big recovery, quote unquote, in earnings. That was, again, base effect, and you're dividing by a smaller number, so the number looks bigger. But there's, in absence of more stimulus, which is the antithesis of what the minutes just said, it's going to be an ugly, ugly, ugly year for earnings.
Yeah, I agree with you. I think the reason chart crime aside, the reason I kind of like this chart is because there are a couple things that we're looking at here, right? So the valuation of the stock market is basically, there are two inputs there. It's the absolute level of earnings, and then the valuation that stocks are getting at any given time. I like that he has, for folks who aren't following along, he's basically got the acceleration, right, of earnings here. So you can kind of see these like peaks and troughs, whereas earnings tend to accelerate, decelerate, accelerate, decelerate. 1985 to 2000, you can see that those would roughly go, earnings would kind of peak at about 21% acceleration. They'd, go slightly negative, right? At a certain point too. And that pattern basically held for about, 20 or so years. Yeah. Post GFC, you had a colossal acceleration in earnings, commensurate probably, right, with the first, round of QE that we really did here in the US. And
morphine,
now you saw
right into the veins. I mean, just stimulus.
Morphine. Right, exactly. It looked like it normalized actually for the next kind of earnings acceleration that was in 2018, and now we've seen 40% earnings acceleration, post-COVID. If you look at this chart, right, you could very easily say, okay, earnings are going to start decelerating now pretty aggressively. They could go pretty negative, right, because when they go more positive, the deceleration tends to go pretty negative. Yeah, pretty bearish for earnings overall here. I think he's done a pretty good job of laying this out. And valuations, which we haven't shown here, are also at an all-time high. So it doesn't really paint a super rosy picture.
It's I don't know. I love Apple, and I just tweeted out the video of Steve Jobs from 25 years ago talking about the purpose of Apple and his theme, think different. Right. Our byline at Morgan Creek is think differently, alternative thinking about investing. I didn't do that because of Steve Jobs, but I was like, yeah, I mean, thinking differently is the only way you make outsized returns. The guy is an absolute genius, and he's sorely missed. And if he were still alive, I wouldn't have this problem where my camera sticks out and I can't put my phone on the table because it'll break the camera. I mean, who designed that? That's absolutely insane. But anyway. So I'm sure there's a reason, but it's bad. But the thing is, there's no way it's worth $3 trillion. Right? They had the same net income, same net income as 2015. Okay, not the same revenue, the same net income, not the same earnings per share because they cut the number of shares through buybacks, which is just financial engineering, but the same net income as 6 years ago. And the multiple doubled, went from 15 to 30. Why would you pay 30 times earnings for a company whose income isn't growing? That's insane. But it's because it's 7% of the index, and every dollar of passive money that goes into the index has to buy 7% of Apple. And so what we've got is bad breadth. And bad breadth is death to bull markets. You cannot have 5, 6, 7 stocks making all the returns and everything else starting to go down. And now the rest are starting to go down fast. And that alligator jaws or dragon jaws, whatever you want to call them, they will close. And
yeah. So I tried to get, this is me trying to do, I was trying to actually, so Lynn Alden actually, leave it to her to just tweet great stuff. So she, I didn't plan on going down this direction, but like she actually tweeted out this this great chart of the top 6 companies, like the largest 6 companies by market cap. Yep. On the S&P, Apple being in there. One thing that is actually pretty interesting about them is that their net debt position, so the amount of cash they have versus long-term debt, is actually positive.
Yes.
Or sorry, net. Yeah. So they have more cash than they do long-term debt. Everyone except Apple. actually. But that, I mean, it's slightly negative position there. So, you could look at that as bullish, or you could say, actually, maybe they're positioning themselves for something. But
well,
I do
want to also say that if they saw good things to invest in, they would be spending that money because they make zero on cash, really negative after inflation because they haven't bought Bitcoin like Saylor. So you're holding cash, you're making 50 basis points, 100 basis points. Maybe they do some fancy stuff and get out to 1 or 2%. But if inflation's running at 4, now inflation isn't really running at 4, and inflation is going to collapse after the base effects wear off. But if it's running at 3.5 or 4% and not 5 or 6 or 7%, then you're still losing money. So I don't know. I am very. You've heard me use this before, right? Where the head goes, the body follows, from my high school wrestling coach, and the head, which is the equal weighted index, is going down. And the body, Fang Man, Facebook, Amazon, Netflix, Google, Microsoft, Apple, NVIDIA, are going with it. And look, I love NVIDIA as a company. I think they're going to do amazing things with the next generation of chips. I hope they buy this new company we're investing in that makes this new generation cloud security chip. But man, I think short term, I wouldn't want to own a lot of it, particularly on leverage.
Yeah, definitely got to be careful with leverage. I do want to get your opinion, though, on basically Bitcoin and what's going on with the Fed. So this chart comes to us from John Street Capital. Or let me set situation here to back up a little bit what I was saying before, just about the transition from monetary to fiscal. So again, this chart comes to us from Lynn Alden. You're looking at private sector loans, government deficits, and broad money growth. So what needed to happen. So basically, I think what this chart is showing here in general is you've got government deficits, and that is peaking at the same time that broad money growth is peaking. And I would encourage everyone to, I'm really starting to, I listened to this great interview with Joseph Wang, who's a former senior trader at the Federal Reserve, and Jack Farley, who's really starting to make me think that actually the real money printer, despite how we talk about it on the show sometimes, is not at the Fed, but actually at Treasury. And real money creation actually comes from deficit spending in many cases,
yes.
Which kind of is backed up by this chart. So John Street, so the reason I give that context is because John Street Capital put out this great, he's trying to basically, put together some data on how correlated is the activities of the Federal Reserve and Bitcoin. So he's got kind of rate hikes, as one input, and expansion and contraction of the balance sheet as another input. And, you can kind of draw your own conclusions here. It might be a little bit small, but basically over on the left, what we're looking at is, starting in January of 2018, going through to December of 2020, we've got the start and end of the Federal Reserve balance sheet, and you can kind of see the net expansion there in one chart. And then you can also see what Bitcoin did. And to summarize, basically what you're seeing is there's not basically any correlation in between expansion and contraction of the balance sheet and what's going on with the price of Bitcoin. You can also see over on the right side of things, rate hikes, the amount of increase and where rates basically were. And that doesn't seem very correlated with the price of Bitcoin either, right? So the reason I kind of bring this up is, Mark, I want to get your opinion on basically on how you connect what the Federal Reserve is doing with the price of Bitcoin. Because now that, there's this larger macro crowd in Bitcoin, they kind of say this is all the Fed and Bitcoin moves based on longer term business cycles and all that kind of stuff. And this data doesn't really seem to support that. So I'd love to get your input here, just in the wake of these new Fed minutes that came out. Just how important is the Fed when it comes to the price of Bitcoin?
Yeah, so I should just beat on this because I tried to hire Justin. He's a domer like me, and he turned me down and went to Pilata. So I should just say anything Justin does is wrong. I'm just kidding around. I would hire him now because I think he's fantastic. And so here's the thing. The problem is you need a lag factor. It takes time for money to flow through the system. So the timing of the Fed expansion or contraction of balance sheet has a lag period of how it gets into the system through bank lending and the banks themselves borrowing from the Fed and buying Treasury, buying stocks even though they're not supposed to do that. They do. So I would So this regression needs to be run with a lag, and I don't know if it's 12 months, 18 months, or 6 months, but if you did a lag period, you'd get a better correlation. We did have an interesting debate this Monday with my guys who there's a guy who's been trying to make a case last year that Bitcoin was actually positively correlated with interest rates, which is just a ridiculous. I think it's just a ridiculous concept. And we had a really heated debate. And they're like, well, look what happened in this 1 month period. I'm like, oh my God, you can't do a regression on 1 month. That is non-statistically significant. I said, yes, interest rates last year went up 45%. The 10-year went from 1.3 to 1.7 or whatever. Okay. And Bitcoin went up 60%. Yeah, that's perfectly correlated. No, right? Yes, there was a temporal correlation a couple times during the year, but they're not correlated in that Bitcoin is priced in dollars. There's one Bitcoin equals one Bitcoin, right? The only reason that it moves is because we price it in something else. We price it in yen, right. We price it in euros, we price it in dollars, right? There's never been a bear market in Bitcoin in bolivars in Venezuela, right? The price goes straight up because the bolivar's gone straight down. So that's a very different price for Bitcoin or in Argentinian pesos. Same thing. So the reality is, I've said this for a long time, Bitcoin rising, a portion of it is the dollar getting worse. Just like stocks rising, a portion of it is the dollar getting worse because we're denominating in a devaluing asset. And so the idea that you can have an inverse correlation to that for Bitcoin, nonsensical. And I think the point they were trying to make, was that, oh, no, this is a safe haven asset and people are going to shift out of it into shift out of equity markets as they collapse, as rates rise, into Bitcoin. It would be awesome if that were the case, but that ain't the case. Like there are 200 million of us believers, right? Sign behind me, 200 million believers. And talking to ourselves, we can convince ourselves that it's a safe haven asset and that we want to put our money there when everything else is going to shit. Fine. But the other 7 billion people on the planet, half of which can't even watch this show because they don't have internet. It's a frightening stat. So they don't care. And what has to happen for continued rise in value of the Bitcoin network is for usage and wallets and hash power and all these things to keep rising. And hash power had been rising up until Kazakhstan. And this could be a temporal thing with the 15% offline. It'll come back. But that's a long rambling way of saying, I absolutely believe that part of the bull market in Bitcoin over the last few years has been the devaluation of the currency and a huge amount of it post COVID. And now what you've got is the situation where we're in this halving cycle, and people say, well, the halving cycle doesn't exist because there's so much demand from institutions. There are a lot of institutions talking about it. Novo was on TV yesterday saying, oh, I know lots of institutions that are definitely going through the process and they're on the verge. Not untrue, very true. We're the same way. We're talking to some very large pension funds, some sovereign wealth, and they will eventually get there, but they're not going to get there soon. And they're not going to buy enough, even the big ones, to really matter. And so what we need is the next billion, right? What we need is the next billion people to realize that Bitcoin is hard money and it is a better form of money. And that will happen. But the value, and maybe, we should do something. We should have Tim Peterson join us. I love Tim from N Squared Crypto. And he's like the only guy who's been sober through this whole thing about all these parabolic price charts. And he said, look, guys, the ones that were created in 2014, they made a mistake, right? Their decay factor for the rate of growth of the network was too high. And so that's where the Plan B and all these others, they came up with that $100,000 number. And I was right there. I was looking at it. But the more I dug into Tim's work, I realized that the decay factor puts us, it's the same trajectory, it's the same shape. It's just at a lower level. We still get to the same place. It just takes more time. And so that level is right around 40K and as fair value of the network today, not 100K. And at that level, we're around fair value. The problem is we can go below fair value if too many people who bought on leverage get liquidated. That's what happens in bear markets.
This episode is brought to you by Fireblocks. I talk to a lot of fast-growing crypto-native funds, crypto banks, exchanges, and the like, and they all tell me they have the same two problems. One, their treasury management setup sucks. They've got analysts wasting time and money on manual transactions. Two, they are not happy with their current security setup. They're sharing passwords, they're sending test transactions, and they're worried that their funds might be at risk. Fireblocks is a platform that solves all of that for you. They're a one-stop shop portal which automatically plugs into exchanges, trading venues, etc. They source deep liquidity and solve everything from day-to-day crypto transactions all the way down to complex DeFi strategy. And the best thing about Fireblocks is that they offer scalable solutions with industry-leading technology. Doesn't matter if you're a 2-person crypto fund or a 2,000-person crypto exchange, these guys have you covered. And the last thing that I'll say about this company is that I have known them for years. They are a high-integrity team. They ship product like no other. I would trust them with my own funds. So, click the link at the bottom of this page and tell them that I sent you. Very, very important that you click the link at the bottom here. Otherwise, they're not going to know that I sent you, and then how am I going to get credit? So help a brother out. Click the link at the bottom of this episode. Tell them I sent you. I have a couple more thoughts about this, and maybe we can transition to, because you alluded to the internet outage in Kazakhstan, and I wanted to talk about that too. But I think a couple of different things are happening here too. One, markets are forward-looking, even not in stocks. They're forward-looking in assets like bonds, real estate, and gold as well. And one thing that stood out to me, actually, if you look at how Bitcoin performed in the 1970s, Bitcoin has this inverse relationship with real rates, right? Because it protects your purchasing power. Gold actually had its best run at the very beginning when people were really worried about real rates. When real rates got deeply negative, gold didn't perform well, ironically, because the thought at the time was, we can't go any lower from here. So everyone should just remember that, right? Markets are forward-looking in all assets, which I thought was really interesting. And if you connect that to what's going on now, okay, we've actually had negative real rates for a little while, but guess what? The period of worry about those real rates has kind of already passed, right? And a lot of people, I think team transitory, at least for a certain period of time, is going to prove out to be correct. And until we get more massive stimulus and money printing and fiscal, then I don't think that's a hard environment, I think, for Bitcoin to do well in, to be totally honest. I think the second thing too is, the framework that institutions have for buying Bitcoin is much more sophisticated than retail investors. It's not just HODL, number go up type thing, right? So I think these guys are either thinking about it from a momentum or a value kind of framework, right? And you got to understand, are you buying momentum or are you buying value? Yep. I think I'm piggybacking here off Avi Feldman from Block Tower Strategy, but I think it's a really valid point. Over the last 2 years, Bitcoin has basically been running up, right? So maybe a lot of people came in and they said, hey, I'm buying this because I believe in the long-term store value. Maybe it was just a momentum trade for them, right? So then you have to ask yourself, well, where is Bitcoin? If they're not buying momentum anymore, because there doesn't look like there's any momentum to be had, what is value for institutional investors? Yep. I don't know, but it's probably not 50K, right? I don't think there are many people who are like, this is a value play at 50K. There are some people who think that, but not a lot, and certainly not on the institutional side. So yeah, I think until you get either a resurgence in momentum or people will set a floor for what they think value is for Bitcoin. But I feel like that's what's going on.
I know, you're 100% right. And that is the nature of all assets and institutional allocators, right? I played one on TV for many years, and I now have a lot of them as clients and some really, really big ones. And that is our job, right? An allocator's job is to determine which side of that spectrum you want to play. And there's nothing wrong with either side, right? The S&P 500 is a Momo index. That's what it is. It's not passive. It's slow active, and it's a momentum index. It buys more of things as they go up.
As they go up. Yep.
That is a momentum strategy. It is nothing more than a momentum strategy. All cap-weighted indexes are momentum strategies, and they work great when liquidity is expanding. And that's not good or bad. It just is a fact. When liquidity is not expanding, those types of strategies get crushed, right? 2001, 2008, right now. Look at the last 5 weeks as the fear of liquidity draining from the system. What happened to the biggest Momo indices? Crushed. And they could get crushed more. So that decision, value or momentum, is really, really important. Now, the funny thing is, I've never met a growth stock manager who said they paid too much for stocks. So they think their value at a growth. And I've never met a value manager who said he was buying companies that weren't growing. So there's this kind of weird in the middle. It's kind of like left and right or Republicans, Democrats. There's no such thing, right? There's in and out, and everybody is really got elements of centrist. I don't hear a lot of people on the left talking about really extreme. Now, there are some really crazy extreme people. I don't hear a lot of people on the right, but most people, like I myself, I am absolutely, positively liberal, I guess, for lack of a better term, in the way I think about social safety nets. And I believe that there should be things to help people who really need help. I absolutely believe that that's the role and function of a well-organized government. But I am way on the other side on conservatism, on things related to taxation, right? Taxation is theft. Inflation is theft. And why do I get taxed multiple times on my capital? I get taxed when I earn it. I get taxed when I go to spend it. I get taxed when I buy a piece of property, when I sell that piece of property. So there's all kinds of things that you can share, but value, I believe, is genetic, right? You're either a value person or you're not, because it's really hard to be a value person in a world that is about momentum, because value is not a good story. Nobody likes value stories, right?
You know what's funny about you saying that, Mark? I actually feel like I have the genetic thing for value.
Of course you do.
In this world of momentum.
That's why we get along. I mean, we are absolutely brothers from other mothers. I mean, that is absolutely true. And 100%. And again, it doesn't make you a bad person if you're not in the value tribe, because growth look, I have this friend and he's way richer than me. I mean, he's awesome. And he's one of my favorite firms that I've invested with for years. And I tell the story all the time. He's a seer, right? He sees things in the future. And when Google went public, right, it immediately went up. And my value friends were like, oh my gosh, this is so overvalued. And it's going to go from 100 to 50. And so I'm out in California with Glenn. And he used to work with Roger McNamee. And just long story short, he says, Mark, are you kidding me? Google's me $1,000. Like, oh my God, you're an idiot. How could you even say that out loud? It's like, no, you don't understand. You don't understand that this is not about the value today. This is about the growth in the future and what they're going to do and how they're going to redefine search and how. And I'm like, yeah, whatever, Glenn. Now, thankfully, I've invested with him for years because he's awesome at seeing the future and being great. I'm not that guy. And people say, well, then why do you invest in Bitcoin? I'm like, well, I'm becoming that guy because I have friends like Glenn who've helped me. Well, one thing, I'm a value guy at heart, except with technological infrastructure. And we've talked about this over and over, 54, 68, 82, 96, 2010, 2024. I believe that now, and I've made a ton of money, not personally me doing it, but investing in people in the venture capital world that invest in these technological infrastructure. Everyone's heard my story about Google and how much money we made for Notre Dame. And our venture funds are doing really nicely because we've backed some really extraordinary founders. But I am deep in my heart, and it's cost me a lot of money. And it's okay. But it's also made me a lot of money. I mean, I bought a lot of good things on sale. So
yeah, I agree. I want to get your thoughts on Kazakhstan as well. We got two stories here, and I know we're winding out on time, but we want to talk about Kazakhstan, the internet outage.
I could go.
I know, me too. We got the Kazakhstan internet outage, and I want to talk about OpenSea because they are just completely on fire right now, absolutely crushing it. But let's just start with Kazakhstan. I thought this was a pretty interesting story. So first of all, there's a humanitarian aspect of this, which I'm not commenting on. I want to get your thoughts specifically on what's going on with the internet situation and the impact on mining. But just to give everyone an overview, there's a lot of protests that are going on in Kazakhstan. There's a relatively new president. I'm going to butcher his name, Kassym-Jomart Tokayev. So he ordered. There are real violent protests that are going on in the city.
Crazy.
There are burnings of buildings.
Handing out guns, people. Literally firefights. It's
handing out guns,
scary.
Firefights, hundreds and hundreds injured, multiple people murdered, police officers murdered. The president has called in the aid of Russia, right, which is a whole other geopolitical thing. I saw this morning that there was a news headline that they gave the order to shoot on site. Crazy stuff. So heart goes out to the folks in Kazakhstan for sure. But one of the side effects of these riots that went on is that they ordered that the internet would be shut down. This was temporary, but something that's happened in the post-China crackdown on Bitcoin mining is that a lot of that hash power had actually migrated to Kazakhstan. Now, what I read when I was researching this is that people thought about that as a temporary home on its way to other locations, but for the period of time, there was a significant amount of hash power to the point that actually it took off for a temporary period of time, an estimated 15% of Bitcoin miners around the world.
Yep.
And that comes to us from Kevin Zhang of Foundry, which is pretty wild, honestly. So that was also happening at a time where the market was kind of panicking over everything that we were talking about previously in the show, which was tightening of their balance sheet, 4 rate hikes coming on in 2022. So that led to Bitcoin falling to over 8% for a period of time. What are your takeaways here? I guess when I think about this story, in one sense, it's pretty resilient, right? Like 15%, almost 20% of the security power, the hash power of the network going offline, and everything still functions correctly. In another sense, I think there are still bottlenecks. I still don't think we've settled when it comes to where mining is going to end up in the world. I think this is pretty bullish, actually, for American mining. People are now looking at, hey, I get it, it's low-cost energy stuff here in Kazakhstan, but maybe that is not worth it because of certain political realities about developing nations. Maybe it's just worth it to pay for the higher rates and be in the United States where we know there aren't going to be internet outages. And I suspect that some of this hash power and computing resources that found their way in Kazakhstan will probably find their way to the United States. And from what I understand, Kazakhstan is already cracking down on the mining that they've seen migrate there. So that was a big overview, I guess, my thoughts. But what is your take?
No, look, I agree with all of the sentiments in that the migration of hash power globally is absolutely a sign of resiliency. We have this amazing redundant network, a network that has now been up for 13 years. Happy 13th birthday. I love January. It's like my first week of January is like this birthday celebration, plethora for me. So I got the Bitcoin birthday on the 3rd, and then I got my son's birthday tomorrow, and then my wife's birthday, my 11-year-old's birthday tomorrow, and then my wife on Sunday. So lots of birthday celebrations. And then you got the Feast of the Epiphany and all this stuff. So, but I think the other part that you bring up that I don't worry about it at all is temporal or temporary crackdowns on miners, whether it's literally, turn off the internet and make it hard, or whether it's, okay, you can't do this anymore like China. It's temporal because there is an economic incentive, right? There is an economic incentive for people to create security for the Bitcoin network. It's the most powerful computing network in the history of mankind. It is, I think, the future of money as we know it. And therefore, the incentives are going to continue to be in place for that that migration to find its highest and best use. And the highest and best use is, to your point, not just cost. It's not just weather. There are all kinds of, I'm sure people have seen the video of the, the Russian one with the snow that got through the roof and all over the miners. And yeah, that keeps them cold, but probably causes, problems as it melts. But, I think it's like squeezing the air in a balloon. It'll just go someplace else. And one of the cool things about technology is the continued evolution and innovation. And I said, we're investing in this chip company that has what we think is a better ASIC. And if it turns out that they do, they're going to sell a lot of them to people. And it'll be the first quote unquote American ASIC, which is kind of cool because then you don't have to buy Chinese ASICs. Right. And I think those types of things that people engineer better ways, they've also got a design for, this is amazing, to bring cryptography into the cloud. So one of the challenges now is you put all your stuff into the cloud and the cloud gets hacked and it gets stolen and you have all these breaches and all this stuff and you're dependent on these singular, companies like AWS and Azure. Well, if you could actually secure directly in the cloud using a new technology, how big is that? That's big. So there's going to be all of this innovation that happens. And so in the short term, absolutely. But see, this is the thing about markets is everybody says, oh, look at this trend. Like you're looking at the last 5 days or the last 5 weeks. The long-term trend actually in Bitcoin is really good. The 13-year trend is amazing. Every year except one, we've had higher lows, which means the network has expanded. The hash power has expanded. The number of users, the number of wallets, all that has expanded. In the short run, you can have disruptions. You can have people say, oh, I'm out. I got stopped out of my 100 times levered position at Bitfinex. I'm out. Good riddance, right? Those are not the builders. Those are the remora. The shark, the whale shark is going like this, and those, the remora come in and get a feast, and then they leave. And so that's a weird winding way of saying occasional stresses in the system are a good thing. It's kind of like bear markets. Bear markets are not bad. They're good. No, they're cleansing. They're good. We need the bear markets to cleanse the bad stuff, right? We need the over-leveraged speculators out. We need the shaky miners in bad places out. What we need is resilience and robustness. Robustness in the network, robustness in the user base, and that all happens during bear markets. And so what a bear market is, it's a time to accumulate, at lower prices, by the way, a bigger ownership position, because all that matters is the ownership position in the network. The daily price, just a liar.
Right. Can I get your thoughts on why? That was a little surprising to me. I was reading about this, that the Kazakhstani government doesn't want Bitcoin miners. I feel like I understood it with China, but I'm not sure why Kazakhstan wouldn't want that.
The only thing I can come up with is they have ties to Russia. Russia has a plan, like China, to have a CBDC. China I think will be first. Russia I think will be second. We'll lag way behind. I think that's the only thing I can come up with, right? Which is if your goal is to avoid deposits leaving the banking system. And so this could be part of it with Kazakhstan too. And it's actually why you're seeing it in the US. Remember, we've talked about this as, 2009 to 2015 was the first they ignore you. Then 15 to 21 was, then they laugh at you. 21, unfortunately, probably to 25 or 26 is then they fight you. And so countries with weak banking systems do not have the capacity to see deposits leave the banking system into crypto. They can't afford it, right? Their banks will collapse. And this is, Russia had a really weak banking system because the oligarchs were stealing the money and putting it offshore. And Putin said, no, bring the money back. I need it in my bank, spare bank, and I won't put you in jail and I won't ask any questions. And everything will be good. and they got 300 billion back, and they recapitalized the banking system. And I think that's part of it, is countries with weaker areas have a choice, right? You can embrace new businesses, new ideas. Like for me, if I was the government, I would say, yes, bring it, and I will tax you, an operating tax that will help me create. And I think that's why El Salvador is kind of thinking it that way, is they're like, this could actually improve our GDP. This could actually improve development capital into, someone's going to have to put money to build out the volcano. I don't know if it'll actually happen or not, but if they do, I mean, that's real money. It's like, why did Venezuela allow oil companies to come and invest for a while? Then they didn't, which makes no sense to me.
Yeah.
You want the money to come in to build out your infrastructure to take advantage of your natural resources. It's why America became America, right? We let everybody come from everywhere and bring their knowledge and their information and their innovation and their ideas and their capital, their foreign capital. And then we became this great superpower. What you want as a country that has long-term strategic thinkers is in-migration of talent and resources to build on your resources.
I agree. Yeah, it's just a funny thing. It seems like clear as day. I mean, this is an industry. It's also like it's capital intensive. You need a lot of workers in a mining facility. It would create jobs. It's actually not like these software companies where it's like 30 people at Uniswap run a, 20, it would actually be, I don't know, but
need a lot of electricians.
Right. Yeah, that you do. So last story I want to cover with you is actually OpenSea. So OpenSea, one of the runaway successes in terms of just a pure infrastructure company. So they've raised $300 million at a $13 billion valuation. Marquee set of investors here. Cotu, Paradigm, etc. So this is their Series C round, I believe. Apparently, I think they were trying to raise at a slightly higher valuation of $15 billion, but they settled on a slightly lower figure. This company is just absolutely murdering it. So there's a couple different dimensions here. So I heard these are unfounded, right? I haven't looked at any data, but this is what I've heard, right? So this is what I'm just going to say. $1 billion run rate, 97% operating margins. What? Oh my God. Right? I don't have access to actually this data. I haven't seen any numbers, right? So I don't know what the trend looks like either. And, we were talking about this beforehand. I'm sure those margins are going to collapse at a certain point, right? They're going to need to hire more people. The fees on OpenSea are high, baby. They are freaking high. And they deserve to be because, they were the first there. Why wouldn't they capture it? But, pretty phenomenal success story. I saw they were acquiring as well. Axios reported $100 million acquisition of Dharma. A wallet they're looking to expand out into. And I think the big question for a lot of these exchanges, whether you're NFT exchange, regular exchange, is how are you starting to interact with DeFi and people who want to live their lives on chain and stuff like that. There was the SOS airdrop token the other day, which is basically like, hey, we're building a decentralized OpenSea. Okay.
Maybe.
Yeah,
it maybe. But here's the thing. Centralization gets a bad rap. I mean, centralization in certain areas is really important, right? We just came off of the not your keys, not your coins day and get your Bitcoin back in your wallet. I've said this before. My 83-year-old dad, never going to hold his own keys. I don't want him to hold his own keys. I don't want to do it.
Shouldn't.
And he shouldn't. He should use Coinbase, which he's very happy to do, or Gemini, right? And look, the thing about OpenSea, and I'm a little sore because we missed it. Although I have a friend here in Chapel Hill who is a second or third check-in, and it's not a big amount, but it's now worth a lot. And he's awesome. He's an early adopter in ETH, and I'm bravo, awesome. But we've done a lot in infrastructure, right? That's our thing. That's what we do. And we invested in Coinbase, and we've invested in Gemini. And Gemini bought Nifty Gateway for $1 million. It's awesome. It's awesome. Nuts. And the guys who sold it thought they were getting a great deal because they had started with nothing. And
I went to school with them, the Cock Fosters.
No way.
We were like 1 year apart at Emory.
That's so awesome. And look, do I think Nifty Gateway is going to be big? Yeah, absolutely. I think the Winklevoss twins are great. Now, the problem for everyone is the lead that OpenSea has created because, and I'll say luck, but look, I'm the Thomas Jefferson guy. I'm rather fond of luck. Seems the harder I work, the more of it I seem to have. So I think they love that really quote. Hard. Well, it's a great quote, right? It's awesome. I mean, and it's so true. And
it's so true.
It's so true.
It so resonates with my personal experience. You create your own luck.
Absolutely
big believer in that.
True. If you don't work hard, you will not be in the places to have the luck happen. Now, look, a bolt from the blue, lottery ticket winner, you can still have, now you have to buy the ticket, but most people who are quote unquote lucky work their ass off. And so I'm not saying that OpenSea was lucky. What I'm saying is what the luck was that there's no one, even the people who originated Bored Ape and CryptoPunks, they did not anticipate how big and how transformational and how potentially increasingly exponentially transformational those communities could be, right? The term social token really didn't even exist. And these community-based organizations didn't really exist. Now we're all kind of understanding it. And actually you guys, Blockworks, right, put out this great thing, Web 1, Web 2, Web 3. Web 2 is about all these permissioned, big behemoths. And Fangman has been great. But Web 3 is about the wallet. So should it surprise anybody that OpenSea just bought a wallet? Because at the end of the day, what you want is a community of users and a collective experience that drives, more volume. And look, the only potential competitor, I think, to OpenSea right now is Coinbase. And Coinbase NFT has, at least last number, it's probably higher now, but 1.8 million people on the wait list, myself included. But they haven't figured out the technology yet. They will. But the question is, it's Field of Dreams, and we've talked about this before. Field of Dreams doesn't work in the real world, right? If you build it, they will come. If you sell it, people will buy it. If you sell a brand, right, people will buy it. If you sell an experience, people will buy it. If you sell a, service relationship, people will buy it. But just having, like I say, a decentralized version doesn't work. You need people. It's like security tokens. It's an awesome idea. And I believe every asset, every stock, every bond, every currency, every commodity, everything will be tokens. But the security token companies and security token exchanges haven't worked because they don't know how to sell like Goldman Sachs knows how to sell to get capital to buy the things. So you can tokenize all the hotels you want. If there's nobody to buy it, it doesn't matter.
Yep.
It's like having the lemonade stand on the wrong corner. Your lemonade could be awesome, but no one cares because they don't see it.
Can I give you a couple outside shot prediction things that I think people are not valuing enough? So you brought up Coinbase. I think they are. So Bank of America recently put out a report about them. They said that the diversification of their revenue is going to accelerate. I'm completely on board. They're doing two things that I don't think people are valuing. One, their NFT marketplace, which they've got like 3 million users, right?
3 million. Okay, it's up to 3 million.
Yeah.
All right.
It's going to be, so then
it's going to be huge. It's going to be huge.
You know what else they have is this wallet, their wallet extension competitor with MetaMask.
Yes.
People are going to use that. People are going to use it because it's the way that most people, you still have to get fiat into crypto is through an exchange, right? So the process usually goes, I buy ETH on Coinbase, then I send it to my MetaMask, then I do all my on-chain stuff. Now I'm doing all this crazy and bridging into all these different ecosystems. But if you think about it, the Coinbase browser extension, that's just one less step that everyone needs to take in. Everyone already trusts Coinbase. People are sleeping on this.
Totally sleeping on it.
The next thing that people are sleeping on is Web 2 companies leaning into NFTs. Now, I understand why. I'm looking at all these metaverse announcements being like, okay, you're going to open a store in the metaverse. Okay, that's lame. But, let me predict. So what I think Instagram actually, I was listening to this great interview Kyle and Tushar did with Jason and Santiago yesterday.
Yeah.
And they said in this interview, I haven't recognized it, but they were talking about, apparently CEO of Instagram is like, yeah, we're going to do NFTs. So Web 2 has the users, man. Web 2 is eventually these Web 2 companies are going to say, we have to do something about Web 3.
But they're not going to win.
Undecided. I agree.
Yeah,
I agree with you. But they will do something in the interim to bring their users over.
Of course they will. Of course, but they're not going to win because incumbents never do it right.
Yeah, they can never fully
because they
embrace it.
They can't jeopardize their existing business model. I use this example of ABC, NBC, CBS, right? They had all the market cap, all the users, all the boomers. We all watched the three networks, and all their market cap, literally all their market cap, went to Netflix.
Yeah,
because people like you stream.
Can I even more than that? So there was an exchange that went back and forth between Brian Chesky, CEO of Airbnb, and the guy who's the founder of Box, whose name is escaping me now.
Yep.
I'll link it in the show notes. There's pictures getting thrown around Twitter, and they're kind of mocking Web3, right? But they're doing it in this way, which is like, yeah, why don't I just like, make all these decisions open to everyone? Wouldn't that be such a great idea? Look, I do think there's I don't believe in a fully democratic voting process. There are limits to decentralization as a form of effective governance. But what I will say is that put yourself in the shoes of a Web 2 founder. What are the problems that you're trying to solve? How do you view the world? Web 2 has been a game of aggregation. You aggregate as many people as you can in the most efficient way possible, and you either sell them ads or you connect them via transactions. Platform business model, ad business model. But it's all about efficiency, centralization, aggregation. That's how they look out into the world. These are the problems that business needs to solve. Web 3 looks at the world in a very different way. They say that is the problem. And it's not even, I mean, like the reinforcing thing, right? You solve problem, it makes you money. That's reinforcing on a psychological level. It's hard to break apart, hey, this is just making me money. It literally blinds you to seeing the world through a different lens and a different set of problems. I don't know. It was a really instructive. I'll see if I can get a picture here or link in the show.
No, look, you're exactly right. And here's the ultimate problem, right? Which is Web 2 was genius in that they took a free service, right? TCP/IP and HTTP and SMTP and all these free protocols, and they built apps on top of those protocols, and they gave them away to aggregate a community,
the audience,
right? An audience, right? And users. Then they found ways to monetize by basically collecting a thing, data, right? Imagine, right? All these people post pictures on Facebook, like for free. They're doing the work, right? They're posting and they're showing you where they live and what they like and what they value and all these things. And you can now, with technology, analyze all that and get incredible insights to make marketing work. Right? I love the fact. I was talking to my son the other day, talking out loud about something, and an ad pops up on my phone. And like, it was, that's so weird. So like, I kind of like it because I was going to buy it and now I don't have to go search for it. It's right there. So, but that's not the future. The future is we, the users of any asset, any service, anything, our attention is our property. Our buying habits are our property. Our need for whatever that service is ours, right? If you're a driver and I'm a rider, the people who wrote code 10 years ago don't deserve 30%. We, the community, and I agree that we don't want the masses, the horde, making the decisions of the company, right? I'm a big believer investment committees should be an odd number and 3 is too many, right? I'm a big believer in centralized decision-making and leadership. Good leaders are worth, that's my favorite line.
That took me 2 seconds. Yeah, that's great.
Oh yeah. No. And 3 is too many. So ultimately, and we got to go, but the reality is Web3 is going to be monstrous. So it's the exponential growth part that people just can't wrap their head around. And it's because we, the communities, are going to take back that revenue and profit. And it's too hard for Instagram or Facebook or anyone else to give up these big advertising-based revenue models to go to this new world. I don't think they can do it. And maybe I'll be proven wrong, but I don't think they can do it. And that's why we invest in the actual Web3 companies.
I'm fully in your camp. Fully in your camp. All right, I know we've got to go here. Mark, this has been a ton of fun. What a great way to start the new year.
Such a good way. Such a good way. And I appreciate the opportunity as always. I enjoy it's the best hour of my week. And
me too.
So have a good one.
All right. Cheers, my friend.
Thanks.
I'll see you next week.
All right.